Audit Committee meeting. Sorry. I'd like to bring the Audit Committee meeting to order. And as we review the agenda, I see the first thing up is a review and approval of the minutes from the Audit Committee meeting held on March 22nd.
I will move.
All right, and I'll second.
All in favor?
Aye.
We were supposed to call that.
Yeah.
Oh, well.
Approved. Good. And then we're now going to hear from UHY on the audit presentation.
Thanks, Michael. Yeah, so I'm Brian Kearns, audit partner here at UHY, and Jessica Blaha, senior manager with us. So again, consistent theme, kicking off the audit plans. So, you know, this meeting in the fall is really your meeting for the committee and management to make sure that, you know, the most important part is really getting your input on any sort of risks that you perceive or know about that you want to make sure that we incorporate into our audit plan. You know, the other objective today is really just to outline the scope of our engagement and then the risks that we have and the general overview of the scope, timing, and what those audit results are. But if throughout the engagement, you know, from the time being engaged up through issuance, if you have any, you know, questions, concerns, want to reach out to us directly, by all means, you know, we'd love to hear from you. You know, so there's a separate presentation here that's bound if you want to go by that, but it's the same that's in the packet too, either way. But basically on the agenda is just, again, the introduction of the team, which is consistent with years prior. How we audit, the audit objective strategies and the focus and the required communications. Again, at the conclusion of the audit, we would actually, you know, in March, go over the actual financial results and the presentation of those financial statements. But so the next page is that team. And again, it's the same team that you know, both on the audit side and the tax side. You know, we have our core audit team plus the tax professionals. And then the scope of the audit, if you kind of, and the objectives, if you go to page 6, again, just as a reminder, I think a lot of us are continuing, but if you haven't been part of these presentations or sitting on an audit committee or been involved through management of an audit, you know, we're the independent auditors, you know, UHY, to provide that independent assurance that your financial statements are free of material misstatement and in accordance with generally accepted accounting principles. That doesn't relieve, obviously, management of preparing and reporting everything, you know, factually and in accordance with those generally accepted audit principles. And so to do that, we take an audit approach that is risk-based, you know, so we do a lot of sampling. And that could be, you know, we take materiality into play, that's both quantitative and qualitative. You know, so we're not doing 100% testing, but again, we get through a lot and we see a lot, you know, of any new grants, contracts, any new accounting policies, procedures, any unusual transactions, along with the large balances we're certainly seeing, you know, in depth and making sure everything is accounted for appropriately. So the areas of audit focus, obviously, if any new projects or the significant transactions that are going, you know, so in the Liberty Park properties, the Clinton Market collectives, any grant programs, you know, your general operation, you know, allowance, we're making sure not only the expenses have been, you know, incurred and properly classified, whether they're capitalized, whether they're expensed, both if any revenue is associated to that is properly recognized, and you know, no quote unquote double dipping amongst grants or secondary funding, that each dollar is spent appropriately and recognized in the proper period. You know, valuation on receivables. The last couple of years too, as you know, there was a large accounting adoption that was related to leases, so that, you know, keeping those updated and accounted for properly. Work closely with Tom and his team to make sure everything is reconciled and recorded properly. We'll get into any new standards this year. There's nothing major, that'll have major impact with it, you know, so we'll save that for the end, but you never know if you run into any new transactions, but. So again, you know, the matters to be communicated, you know, the engagement letter obviously sets out the terms of the scope and what we're reporting on and what management's responsibilities are versus the auditors. Just to note, the two engagement letters that have been set forth are consistent with previous years for both tax and audit of the financial statement. Currently does not include if you need an audit in accordance with uniform guidance that you needed last year because of the threshold of federal expenditures being over 750,000. So if you do have that, again, this year, we'll just do an amendment or a separate agreement to add that program audit if you expect to have. I don't know where you shook out this year. You didn't expect one though, right? Yeah, so it'll be back
Spend all
to
the federal money in
Good.
the prior year.
great.
At
We
least
could always
out
use
of
more,
that.
yeah. If anybody
Might
wants-
been a little bit.
If any new ones come along, just keep us posted, and that threshold is changing for 25. It's going up from 750,000 to 1 million. It's a little relief there, but it's, you know, nothing major. What's that? Oh, okay. You know, again, with materiality, just talked a little bit about that and, you know, and significant findings, the results of the audit. We have on there, because it's required, any illegal acts that come to our attention. Obviously, if that happened, we would reach out to you guys directly and immediately, we wouldn't wait for the conclusion. You know, same thing with fraud, as we inquire of both management, you as a committee as a whole, if you're aware of anything, please reach out to us directly. There'll be some incoming, you know, inquiries that are routine, but if anything came to our attention, we of course would share that with management and those charged with governance in a timely, immediate manner. At the end of the audit, because this audit is done in accordance with government auditing standards, and that's because you're complying with Paris rules, laws and regulations. It's done under government auditing standards, and that includes a report over internal control over financial reporting and compliance with laws and regulations. So in addition to that, if there were any significant deficiencies or material weaknesses in internal controls that rose to that attention, in private companies, those are just communicated as a management letter, separate correspondence. In government auditing standards, if you have any of those would be part of the financial package and would be public, you know, as that. So those would be communicated in writing at the conclusion of the audit. Most importantly, of course, is independence, you know, the UHY, while we, you know, encourage year-round communication with management on a number of topics, and, you know, we want to be aware of all things operating, you know, that's affecting the corporation. We are, you know, we are independent. That timeline, overall timeline, you know, just working backwards, obviously, you have the March 31st Paris reporting deadline, so we'll be, so everything that we do is, you know, is working closely with management to make sure that you're in compliance with those reports. There's a lot of public authorities out there that are not in compliance. We won't go there, you know, we're gonna stay in compliance with you guys and work with you closely to make sure that those reports. So shortly before that, obviously, we usually convene middle of March to go over the results of the audit so that we could finalize everything by the end of March. So that means the field work is traditionally done, quick turnaround time with Tom and his team to get from 12/31 to basically the beginning of February. You know, that 1 month to close everything and make sure everything's accounted for and reconciled and all our requests are made, and usually it's like that first week of February that we're usually doing field work, but we'll coordinate with, you know, Andrew and everyone with management to make sure that that's, but again, we see that consistent with last year. And then before year end, of course, if there's anything new or any new agreements or anything large in change of operations, we'll do a little planning and make sure to coordinate all that with management as well. So again, we already talked about those deliverables, which is reporting on those financial statements along with the internal control, you know, at the end of March, and then we'll follow that up with the 990. On page 12, there's no accounting pronouncements. Destiny, did you wanna talk a couple minutes about those?
Yes, and, another point I was gonna bring up too, I don't think put it in writing, so also wanted to communicate that during planning, Brian had mentioned that we have our risk assessment and we are required to communicate what the expected significant risks where we spend a little bit more time on would be, and it hasn't changed from last year during our audit plan. The only significant level risks are the ones that are just pervasive to all entities that are expected based on the standards, nothing in particular related that makes something from Capitalize Albany based on our audit plan. If it changes, we'll communicate if we need to look into another area, but right now it's management override of controls, which is everywhere. You have to look at that. And improper revenue recognition is also considered just a pervasive fraud risk everywhere unless something particular kind of calls you out that it's not. So there's nothing. So I just wanted to point that out since I think we don't put it in writing here. And so on the new accounting pronouncements, GASB 101 is the only one that's gonna impact 2024's financial statements. And this is more on, the standard setters wanted to get everyone on a more consistent basis. They seem to see that compensated absences, there's a lot of judgment in what you think should be accrued for, say, vacation time, sick time you offer to employees. And then there's also some other payroll related expenses that go along with even, with like vacation accrual. Some places will accrue for vacation based on the hours and payroll rate, but not necessarily accrue the expected payroll taxes that are gonna go out with those. So this may or may not be an additional accrual when we look into it. I would say during our audit procedures, we'll just make sure to work with Tom and make sure we have the updated employee handbooks and know the policies to properly assess because right now I don't believe there is any accrual. And if there needs to be, also based on materiality, we'll assess within these new guidelines. A lot.
Carryover.
And that will be the thing to consider is now you might still not need to make an accrual, but might need like a memo to say why not, because they took away with the real like sick time. It was always, well, if you can't carry, like you can't accrue it, like you get no payout at the end. So you don't accrue for sick time. Now they want you to look more, what's the probability someone's going to use time that they've already earned? So if at December 31st, someone has earned, a week of like sick days that they can still use for a period of time the next year, that not necessarily, even if they don't get paid out and they quit, doesn't have to have the cash payout. It's more like a 50%, more than 50% chance that they're gonna use the time, that if, as long as they've already earned it in the previous period, they would like that accrued back. Which most might put in their memo an argument that, well, we don't know. We can't determine it's more than 50% likely, and they may be looking at your turnover and there is no payout, so we determine not to accrue for it. And so I think it would just be something like that. It might need a little bit more documentation of why to follow the criteria, because they get a little more specific about the terms that mean you need to accrue back, and it has less to do with actual payout expectations, more what have employees earned at the end of the year. And then the payroll taxes also is kind of some people don't, some people do accrue payroll taxes on their compensated absences. Obviously, if you don't have any, you won't have to worry about that. Same thing with, that it even goes into defined benefit plans and OPEB. They want it to start accruing a payroll tax expectation of that you would additionally have to pay out on any salary related payments, which wouldn't impact you, but they're just trying to remove the discrepancies where everybody's deciding what is a compensated absences and should it be accrued. So I think on this end, it would be a small accrual if you needed it probably, or a memo that's just saying why we don't relate it to these criteria.
Seems odd to
Yeah.
me. It's very, very odd, because they're assessing the value of the workers' productivity. Where normally it's just they wouldn't show up for a week
Right.
and the organization just wouldn't have as much service from that person.
Sure.
But they're now calculating it as if it's a asset.
Right, right, and I think, you know, the type of entity makes a large difference, right?
Right.
Obviously, if you were a one-person convenience shop
Yeah,
and your clerk is out sick for the week, I
Right.
need to replace them with
Right,
those
right.
wages with
Right.
somebody else, and so if they're out sick, I got 2 weeks of salary, I'm paying the sick
Yeah.
person plus I'm paying the person, but.
How does that work with paid family leave? I mean, government mandated programs.
Those would not be
Right.
required. Yeah, if it's something, outside of the entity itself's, ability to know. Cause you wouldn't be able to predict if someone was gonna go out on, the family leave.
I mean,
And it's nothing that they've earned it
Yeah, like,
either,
they didn't
that
earn it
they're.
for
Like your new employee is almost arguably just as entitled to that benefit as
Right.
someone that had been there 10 years. So that's a current service expense in the current period. And so to your point was say, okay, well, if someone was just taking off the month of January because they've earned it from the past 10 years of service, arguably that was a prior service cost
right.
that you should have accrued for arguably, right?
Yeah, I mean, one would argue that you've already expensed it.
Right.
Like, that time they earned, they were compensated with time off. They accrued it. And then now they're using, I mean, you had reported it as an expense in a way.
If you accrued
In a
it,
way,
if you
right.
accrued, if you
If-
accrued their accrued compensation time, right, when they took it, you would just release that accrual.
Yeah, so
Yeah.
Would that vary by company, like just culturally or even by employee? Could it?
It could,
Yeah.
because especially if you're trying to factor in if someone's gonna, that more likely than not that they're gonna take something. Could depend on how new the employee is versus your more longer term employees of who's actually, how long they typically take their, say, sick time. Every year if they earn it in a previous year, some sort of thing, so it could be decided based on very individual. Now, but you could then just look at it from a bigger perspective. First, and right, your understanding and how Capitalized Albany assesses and looks at their, and then have more of a kind of.
Yeah, if you had
Broader
unlimited
policy.
PTO.
So unlimited doesn't,
Unlimited
right,
would not-
right, so that's where a lot of people are
There's an
getting,
exemption.
exactly, where it's basically not accrued, because UHY just went through the
Since there is no
FTO, flexible
number.
time off,
Right.
and unlimited PTO per se, and that's because. I mean, obviously, it's all
put a number.
monitored and everything, but there's no value out the end.
You're
And
not really earning it because it's just available to you at
Right.
any time.
correct, and arguably that person that hasn't started yet has the same benefit as the person who's been 10 years.
Yeah.
Whether they get approved for less or not, by policy, they're equal.
Well, we booked this meeting for an hour, so I was gonna let you guys roll with it.
Yeah.
Probably material to the audit this year,
Yep.
but we appreciate it.
Yeah.
Yeah, that's good.
Yeah, so then, next in 2025, GASB 102 would be there, that is more footnote related only. Related to, any significant concentrations or constraints, just to get a little bit more detail about any possible risk related to credit risk. On the FASB side, they had CECL and all that crazy stuff. I think this is GASB's light way of addressing this, but it's just footnote disclosures, and so that'll be looked at the time. And then 103 is for 2026. The main thing here that I see with 103 is just potentially some changes to the management discussion and analysis process. They're looking to quantify and qualify like what you're gonna put in that MD&A a little bit more. Some places don't put as much as they probably should. They just tell you what the changes are in accounts and don't really go into why they changed. So if you're already doing a good process and describing what's happening in the company, I don't think GASB 103 is gonna do much to you. It's more the places that have much more minimal in their MD&A.
Yeah, you're familiar with ours. Ours is pretty lengthy,
Yeah.
so.
Yeah, yeah.
You're explaining, so I don't think that's gonna have much there's a couple other things in that standard, but that's really the main one I noticed.
And over the last few years, I mean, just a quick recap, right, that we've been in healthy discussions about, that's been substantial to your audit is sometimes the revenue versus expenses, what's getting capitalized versus not for changes in net assets, so specifically when we have a grant paying for something, right? So if it's straightforward, we got a grant to cover these expenses, it all happened in the same period, it's great, you're at a net zero because you had a grant pay for these expenses. At times though, of course, you were incurring costs prior to getting those reimbursements. Well, if you've earned them, there's no reason why you can't book that revenue and book a receivable, and from a P&L net assets, you're still at a net zero. However, we've had times where we said, well, we've incurred the cost, but due to the grant agreement, once you start dissecting it, management may come up with the determination of saying, well, technically, we haven't earned it yet. We're fully gonna get paid for it, but from an accounting perspective, we haven't booked the receivable or the revenue yet because we haven't dotted our i's, crossed our t's, and met those benchmarks to actually earn that drawdown or record that drawdown. So you might have a timing difference there. And then obviously, when we purchase fixed assets with it, or equipment or construction in progress, certainly with Clinton, ultimately, you're trading cash for capital improvements, but then when the grant pays for that, you're really now getting cash, and it's an increase to your net position. Ultimately, years down the line, you're gonna be depreciating those assets, right? And so you'll have an expense that might not be, a break even. You'll have a depreciation, a non-cash expense that'll start bringing down those net assets. So again, just keeping that in context for everyone, the users of the financials, to having a reminder over, because over the last couple of years, there's been a substantial amount of capital improvements related to Clinton. Some of it hasn't been all drawn down and recognized in terms of those grants. They're still coming. So you'll have that revenue come in, you'll have that bump up in net assets, and ultimately, it's gonna be placed in service, and you'll have that depreciation. Talking, with management on that, I know there was some very limited use, this year, but it's still considered as of now to be in progress, and they'll still continue into the spring, so probably will not be placed in service until 2025. And I think there was initially, some revenue related to a grant that was planned on being recorded and received in 2024, but it's still pending. I think as of right now, it's management's determination. It could change over the next couple of months of what comes in and what i's and t's get crossed, but right now it sounds like it's gonna be a 2025 event.
Most likely.
Okay. But that's really what we have, but if anybody, has any concerns or make sure we incorporate anything into our audit procedures, by all means, we'll make sure that gets included in our planning.
No, this is great.
Yeah.
Heather, did you have any other
No, I'm good.
questions? Yeah. Always learn something. Well, thank you. I'm sure it's gonna be a fairly smooth process this year, and
Exciting.
the.
Here's hoping, not excited.
Yeah.
Boring.
One of the times, whenever we present at the end, boring.
I prefer it to be boring. I don't need excitement in this part of my life.
That's right. We're not looking for excitement.
No.
Agreed.
Go to finance committee for that.
Yeah, right.
So I think with that,
I think two separate motions,
Yeah.
Tom, two separate motions to accept and approve the proposals, the one for the audit and one for the tax engagement.
Yeah, that's perfect.
Okay.
okay, so motion to accept the audit engagement?
Second?
So all in favor?
Aye.
Aye. And motion to accept the tax engagement?
So moved.
And second, all in favor?
Aye.
So approved. And I'll sign those after,
Yes.
the
that'll
letter.
work
Yeah.
out.
Okay,
All right.
good. I think that's it.
Appreciate it.
Thank you
Thanks.
very much.
Yeah, because
It's up to you.
Yeah.
if you wanna
If
hang.
you
it,
wanna
you guys
hang,
can
yeah,
just
we're-
Review some of the policies.
Yeah,
Or if you guys wanna depart, that works for us too.
we're gonna review the ethics, which I think
It just basically says the ethical.
Yeah, be ethical, to follow the amazing standards that we've always followed.
Yeah, and so, this is, encouraged and recommended by the authority's budget office to be reviewed annually. And
Yeah.
you'll see that as a consistent theme with the ethics policy, the conflict of interest policy, and the whistleblower policy.
That's right, and I don't think we had any, reason last year in changing, deviating from the authorities'
Right.
recommended policy. Yeah.
The most recent
Yeah,
legal requirement, and that has not changed.
Yeah.
So, at least pieces of the content in each of those.
yeah. And I know we were very diligent a few years back to make sure we tracked everything. And the board was, aware of any, all the elements required, so.
Yeah, the most recent, edit I recall on the ethics policy was, I think, adding the ethics officer. Is that correct, Tom? I think adding general counsel as the ethics officer was
Oh,
one of the
okay.
most recent changes
Yeah.
that we did on that.
That was last year though, right?
Yeah, I
Yeah,
think so,
yeah. Okay. So do we need a motion to accept our policies, or is this just a review?
It is just a review.
Okay.
So I think.
Good.
No
Any
review.
questions?
No, this is all the same.
Yeah.
Just note that we review them.
All right, wonderful. So with that, we will accept the policies and recommend to the board that, no changes. And move forward, and with that, any other business?
That covers, so all three policies, so ethics policy, conflict of interest policy, and whistleblower policy, all have been reviewed.
Yeah,
No changes proposed, and you're recommending to the board. No, I don't believe there's any further
okay,
business. for-
all right. Well, with that, we can close the meeting. Everybody can pick up a little more time in their day.
I move we adjourn.
All right, all in favor?
Aye.
Thank you, everybody.
Thank you.
Great presentation as always.
Thanks, everybody.
Thanks, Tom.